Hey, everybody. Thank you for joining me. The stock market has finished in the red today. The Dow Jones down 71 points, the NASDAQ down 13, and the Russell 2000 down was the worst of the day, down about 1%. So today stocks were down, bonds were down, metals were down. So not a lot of places to hide today. As you can see from the chart, this is a 1 minute picture today of the Dow Jones. And pretty much, we kind of sold off right at the beginning, kind of rallied back, and then it just trickled down all day right into the close, and really never saw any buying to speak of at all. Now, we mentioned the other day for our aggressive accounts, we had kind of our trading accounts had actually covered our short position, and we said that was a first step because the stock market was at a point, especially if you look at the S&P 500, was at a point where we saw, 50-day moving average had held up several times before. The last time it did not, and so actually the 100-day moving average was the place for it to bounce. So we said, hey, we weren't going to buy at this stage, but with the cash we had, but we were going to cover that short position. It's a little premature. The market's fallen a little further, but we're getting really stretched now to where I would actually prefer a day like this where it opens down. We touch the 100-day moving average, big downdraft, maybe like 150 points down, and then it turns up in the middle of the day, and then we get some follow through. I think that would be a healthy, a healthy thing that would flush out a lot of the sellers and exhaust the sellers because, it was clear the market was holding up very well. And we had been moving sideways, but now you see the S&P has rolled over. It's clearly broken the 50-day moving average, as it did here. And now you have to believe the 100-day moving average is in play. And I think also when you look at this, don't forget that from this bottom here to this top, the 100-day moving average represents about half of that move. So in other words, if it goes to that would be giving up half of the gains from the bottom to the top here. So that would be... We're getting extreme on some of these short-term oscillators, and I guess the bigger question is, has there been enough damage done that lead us to new highs, or is this just the beginning of what's going to be a nasty summer sell-off? I think the timing's interesting because we're getting a sell-off. Obviously, we could get oversold enough to generate a rally, but is the market really going to rally all the way until the Fed meeting, given what's going on with interest rates? So we'll address that in just a minute when we do look at rates. But overall in the market today, the S&P down about 0.6%. Not a terrible day, but certainly the sellers dominated today. This is not one of those days where, people just kind of took the day off and the markets just drifted lower. It was a fairly intense selling out there. Really, the only sector that was really green today was healthcare. This is one of the only sectors that I'm long as far as some individual sectors. So healthcare held up. It was up about 0.2%, nothing great, but it was in the green today. If you look at the Dow Jones, that one has actually not only broken the 50-day moving average, but it's broken the 100-day moving average. So from a technical perspective, you have to look at the old low now as the place to be, and that might be somewhere around, let's call it 14,750, something like that might be the place that this could come down to and test that. But again, as I mentioned last week, what we might want to look for is if it does bounce it bounce to, let's say the 50-day moving average extends out, does it bounce up to there and roll over? And now what do you have? You have this head and shoulders, and then we get, a further move down. That's a possibility. So we're going to get a bounce, and I would suspect it would be within the next 48 hours or so, meaning if it doesn't come tomorrow, I think it definitely comes the next day, and I would like to see more of an intraday reversal. I think that's what some of these reversals look like. We had it back in July. We had it back in April where the markets open down, and then they either finish much less off they finish off their lows, or they even finish positive on the day, and we see what kind of volume there is, and we need to see, once it does bounce, what kind of strength does it have behind it. So we're watching that. Now, as I mentioned, not only are stocks going down, but bonds as well. So treasury bonds continue to fall and really get hit hard as interest rates move up and have broken some of these trend lines and appear to be headed straight to 3%. That may be a nice round number where the pause is. And I think something that's interesting, the stock market selling off has not caused people to go buy bonds, right? 3% is better than 1.5%. It's a much more compelling deal to buy a treasury bond today, and yet we still don't see money moving in there. There's not enough fear that has caused people to go into treasuries. So that's how you know maybe we're not seeing real fear. If the fear really needs to pick up, you would see treasury bonds rallying. No matter what's going on with tapering, when there's real fear, treasury bonds will rally. That I believe. Now, you see the interest rates continue to go up. They had paused at these levels. They seem to be breaking out. And at the same time, volatility is picking up. And we showed this picture last week. And let me take this off of here so you can get a cleaner look at it. But we pointed out that each of these spikes was eventually a buying opportunity. So we've had these spikes in the volatility index. We're getting it again. Where is that ultimate level? Is it 17? Is it 19? Is it 21? I think it's going to be more of the 17 variety for the short term, where we spike up, markets are already oversold, and then we turn right back around. So we'll see. I think it has been amazing. We've seen a very big move very quickly from complacent to fear. And it's not all showing up in the VIX. People aren't terrified, but I do sense that people are nervous right now. They're nervous about the Fed. They're nervous about interest rates. They're nervous about Egypt and the chaos over there. They're nervous about who's going to be the Fed president, and tapering's right around the corner in September potentially. But the Fed's in a real interesting predicament right now, aren't they? Because they told us about tapering, and what we saw was interest rates respond accordingly. Okay, interest rates should be going up. But how much of this move is taking away the tapering? How much of this move is a complete bond bear market? How much of this move is inflation? Right? Is inflation starting to pick up? Now, some of you may argue it's always been here, but we've had disinflation for a while, especially when you can look at things like wage growth, which is a component. But now you're starting to see certain aspects picking up. Gold has started to do well. Materials have started to do well. Interest rates are going up. Some of these spread indicators we look at are pointing towards potential inflation. So now what you have is the Fed's going, okay, if we have inflation, we have to taper, but do we really want to be tapering when interest rates have already gone up and the economy is starting to look spotty in certain areas? And so that's it. I mean, the Fed has painted themselves in an interesting corner. I think what's likely to happen is, so they can save face, maybe they do taper, but instead of going from $85 billion a month down to 60 or 50 billion as maybe they were going to do, maybe they drop it from 80 billion a month or 85 billion, whatever the number is, and they go to 75 billion. And they do it on a much slower pace. Instead of doing it every 6 weeks, they're doing it, every 3 or 4 months. Who knows? We don't know what they're going to do, what's in their mind, but certainly what I understand is happening kind of behind the scenes is that there is a debate going on as far as how much and how soon that they do this. So we'll see. And don't forget, and this is very, very important, every time QE has been announced, quantitative easing, every time it was announced, interest rates spiked up, and then when they actually started to do it, interest rates came down. Okay, so it was a buy the rumor, sell the news, or sell the rumor, buy the news. But now what's happened is they've told you, hey, we're thinking about tapering, and the market has said, okay, we're going to sell bonds. But when they actually start the tapering, who's to say that interest rates don't come back down? So it's something to watch. I wouldn't position your portfolio for that, but I would certainly, I think it's interesting to watch and something we got to pay attention to, because that is that's been the past, has been the market prices it in, and then when it actually happens, interest rates have moved the opposite. So we need to watch that. So let's visit gold real quick. Of course, it's had a big move recently. It not only broke through the 50-day moving average, but it's now pausing, just as the stock market looks like it's destined for its 100-day moving average on the upside of it. Gold is trying to get above its 100-day moving average from the downside. So now what you have is these short-term moving averages are crossing the long-term, but what you're seeing is gold pausing at a level that it probably makes a little bit of sense to pause. We've had a big move up, and now what you're seeing is it could pause and continue to make higher lows and work its way up. Again, why? Because potentially people are just rotating. You've seen Europe outperform the U.S. stock market. You've seen gold outperform a lot of other things like financials and all of those areas. So you seem to be having some type of rotation. But again, nothing suggests that this is a long-term bear market starting right now. I think the fear has picked up, but I think we've seen some kind of rotation here in the short term. But the stock market itself was, we looked at the other day, the fact that the stock market had, let's put this back on real quickly, was in this tight, there wasn't much volatility at all, right? Change arrows for you. There was a real tight where the market was just moving sideways right in here. And we said it's going to break out one way or the other, and the longer it goes on here, it's probably likely to break out to the upside, if anything. And it broke out actually to the downside. And now what we're seeing, and then a lot of things were overbought at the time, but what we're seeing now is that this is in play, this 100-day moving average. But I would caution you before you get too bearish. If you look back over the last few corrections, what's happened, even this one, is that the markets looked like they were breaking down quite a bit back here in late June. I mean, they really looked like they were rolling over. The 50-day moving average had cracked for the first time, and everything was pointing south. And then it just reversed. And so there's still, if you're somebody that is needing fixed income, you see what's happening with interest-sensitive type investments. They're more volatile than usual. So while the income's still coming in and being very productive, the amount that's producing the income is volatile. So you're scared of that area, but you're also scared to earn zero in a money market. So what's the default? The default is the stock market. And now that's starting to get bad, but I still think ultimately that's where money ends up flowing. And there's still a lot of compelling deals, but the thing is the stock market is reaching a level right now where it's getting very stretched. So even if you are very bearish, you're going to get a snapback rally. And whether it starts tomorrow or the next day, I'm not sure. We've had 4 down days in a row, and you are seeing some pretty interesting streaks down. We talked about Exxon the last, I think at the last podcast. Look how many down days it's had in a row. We've only had one up day, and this goes all the way back to July 23rd. We're approaching 1 month of straight down for Exxon. I bet you there's not many times in its history it's had that. And I don't know if that's a screaming buy or if that's something so unusual we should be cautious. Exxon is a very cheap stock and one that is on my radar because I think this is a company that, if you go back and look at it, it hasn't done anything really. I mean, if you look at the price now, it's at the same price it was in 2011. It's moved completely sideways. And in fact, if you go back, even further to the pre-crisis days, this is a stock that hasn't gone up really. It's now we're going back to 2007 that it hasn't done anything. Now it's moved. Obviously, if you missed it and bought down at the lows, it's made a lot of money. But it's a compelling deal. But this uptrend that it had been in since 2002, if we get a little more precise with it, has broken. And you can see these bottoms here, and it's broken to the downside. So, I think Exxon has the ability, I don't know if that's the right word for it, has the ability to get down to the lower 80s. It's at 86.92. So let's watch it. But I point that out just because I'm watching these streaks of stocks. I think even something like a Walmart has also been getting hit pretty hard. But overall, there's still places to be. I think as interest rates rise, the banks were one of the few places that were raising their guidance and so forth. They're getting hit. When you look at financials in general, they are getting hit as well. They broke out of this earlier, and then they moved sideways, and now they're coming down. So now, once again, they're testing their 100-day moving average at some point here, but that's where they bounced off. So let's watch. That's going to be a critical area in the next couple of days. But more so than anything, and the thing that's hard to I don't have time to go through every single indicator I watch. A lot of these are common. A lot of them are ones that I've created, and they're kind of proprietary as far as how I look at the data. A lot of those are getting stretched to the downside. They're not all green lights, but a lot of them are coming into that zone where markets will rally. The question we always have to ask is, are you planning for a 2-day trade, or are you planning for a place to buy for the next few months? Because those longer-term indicators aren't there yet. The short-term indicators are getting very, very close to where we should have a rally and it should be a big enough rally to where it'll make people question, should they have gotten out at all? Okay, but what we want to see is real strong. We would love to see a reversal, intraday reversal tomorrow or the next day, and then follow through. One of those 90% up day where all the volume's up, you have everything participating. What you're seeing now is a lot of things joining in on the downside. So the real thing that's changed in the last, couple of weeks here is that while really since, when interest rates first started going up, the stock market sold off. Then it started rallying even though interest rates were going up. Now it's selling off again as interest rates are going up. So interest rates have been persistently going up. The stock market seemingly didn't care, and now is it at a tipping point that it is carrying. And the only way we will know that is if there's follow through to the selling. But so far, don't make moves one way or the other too big. But I'd say if you have cash you want to get put to work, there's going to be a trading opportunity in the next few days. But for the medium term, we need to see some type of commitment on the part of buyers before we commit, a bunch of new capital. All right, folks, have a great evening, and we will talk to you soon.